Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, June the 3rd, 2025, recording this about 7:30 in the morning. Okay, so it seems to me that what the market's trying to figure out is what's happening here with the US economy. Obviously, there's always got to be sort of headlines on tariffs. We now have a new headline that the US apparently has given a lot of countries a sort of a deadline by tomorrow, Wednesday, of their best offer to the US in terms of trade and tariffs. That is a very rushed process. Probably a lot of the major trading partners will not be able to kind of keep to that sort of timetable. But basically, the idea here is that the market, in my opinion anyway, is reacting less and less to sort of headlines and is really waiting to see the specific outcomes of any sort of tariff implementation. So that's putting the focus a little bit more back into sort of, let's call it traditional macro, just seeing where the real economy is going and monetary policy and whatnot. And we can see this in something like the S&P 500 futures here, the ES minis. That they've basically been trading within a range of the last sort of 10 days or so. There was some kind of sort of shooting star, which normally is a bit of a rejection candle here. You see here last Thursday. But subsequent to that, the market's sort of, holding in there. The moving averages, at least the 100 and the 200 here, are sort of going sideways, maybe even with a tiny bit of upwards momentum. But essentially at this point, we're in a bit of a holding pattern, and it's almost as though the market has some kind of sort of protective collar, in the sense that the market wants to be long the market wants to be long the stocks, the equities, but it also has a protective put, and because it thinks that it could be sort of having a bit more downside, and then it's going to be sort of selling a call up here somewhere, just because it doesn't have a lot of confidence that Trump's policies will ultimately sort of support the economy, and that tariffs ultimately will damage the economy. So it almost seems as though we're sort of in some kind of range with the top of around about 61, 61.50, but maybe a potential downside, maybe not a collapse, but down to, let's say, 57 or 5600. So we seem to be in that range at the moment. So let's have a look at the data. And try and figure out whether the US labor market is sort of weakening or what's going on. And we had a little bit yesterday. We had the ISM numbers, and again, keep in mind that the ISM numbers are, of course, it's just a survey. And I'm just going to bring this up here. I'll just use the daily shot. They have it. So we had the manufacturing PMIs, and keep in mind also that one of the major themes of the last probably like 3 to 6 months has been that the survey data, the so-called soft data, has always been a little bit more pessimistic than the actual results, the real data. So really what the market's trying to figure out now is, at some point, will the survey data sort of harden up and reflect more confidence and less pessimism? Or on the other hand, will the hard data, the real data, actually start to fall and show some weakness caused by the tariffs or whatever? So we're trying to figure that out. So keep in mind that this is just a survey, and the quality of the surveys since COVID has been going down. Just another sort of meta thing to keep in mind. Just because there's less respondents who are actually sort of responding to this. But anyway, we had the headline number, which is a little bit lower than expected. So it came in at 48.5. So that is in contraction territory for the headline number for manufacturing. But then if we actually look also that employment, the employment number was still in contraction territory, so below 50. So that's weak. What is interesting to me, though, is like the imports are completely collapsed. Now, that could also be just with the April, that people with the tariffs, they front run them in sort of February, March, and imported what was, necessary, or front run a little bit. But now with just the tariffs being imposed back in April, people were importing less. So that's I think, to be normal. We'll see if that's sort of going to be unwound. The other interesting thing, which is a problem for the Fed, is that the prices paid component of the manufacturing PMI actually, it was supposed to be, it's still almost up to 70. So as we can see here, basically all of this year, 2025, the prices paid, so the input prices are still going up. And also, if you look here at sort of factory prices, they're also being raised and are being pushed up. So I think what the picture of the ISM survey is giving us is sort of slowing activity, but basically still sticky inflationary pressures, possibly brought on by sort of supply chains being less efficient and tariffs, of course. So that's what's going on. Now, in terms of the data today, we also had factory orders, which were a little bit lower yesterday. But in terms of the data today, we do have the JOLTS number. And let's just have a look at that. So, of course, that's the job openings and labor turnover. So what we're trying to figure out, and actually before we look at that, I just want to show you a little bit what's been going on there. So I've got a couple of graphs here, courtesy of Hedgeye. I'll give them a shout out. So basically what was happening here is that we're not really getting people being fired. So you can see here the lower one here, employers are not firing people. So remember what happened in COVID, it was very difficult to get workers. So it seems as though companies, even if their economic activity is slowing a little bit, they're not actually firing people. They're sort of being a bit more conservative in that sense. So you can see here that employers aren't firing, and the firing rate is actually sort of relatively flat, although it has gone down a little bit. On the other hand, companies are also not hiring. Okay, so they're hiring slow, it's slowing and slowly. Okay, so we're getting a sense that the job market seems to be slowly weakening. So companies are not really firing people, just a little bit, but they're not really hiring people and just having a little less hiring as well. So definitely a softening in the labor market, but it's pretty slow. On the other hand, the workers aren't quitting, and normally that's a sign of sort of a weakening labor market. Remember that people will tend to be more confident and quit if they believe they can A, get a job quickly, and B, another job quickly, and secondly, if that new job, it will pay more. So the fact that workers aren't quitting anymore or not in any great numbers indicates just a general slowing. So my takeaway of all of this is that the labor market probably is slowing a little bit, but it's very soft, and it's not falling off a cliff enough. And why does that matter? That matters because the Fed has basically said that because of the sticky inflation, which we've been looking at, they would have to see essentially a labor market which is deteriorating rapidly and dramatically for the Fed to have to sort of start cutting rates anytime sort of soon, certainly not as sort of the June or July meetings. On the other hand, we can also see from this chart here that the number of weeks, the median weeks of unemployment's gone up to 10. So what we're starting to see with the continuing claims is that it is taking a little bit longer for people to actually find a second job. So that's kind of interesting. Now, we have a second chart here, which is a little bit more sort of optimistic. So if you look at the recession, what they've got here on the left is the probability of recession, at least according to economists. And of course, that's going higher and higher. So there's quite a lot of negativity coming out there amongst commentators and economists saying, oh, but you guys don't realize that, the tariffs are going to cause the labor market to weaken and unemployment's going to skyrocket and anytime now. And so this is getting quite important now, as I think mentioned yesterday, that now we've had the tariffs, which have been sort of on and off in the April period. We're now getting into June. So probably in the June or July period, especially, in theory, we should start getting data which will be reflecting, let's say, the May and the June periods for the data collection. Now, if the tariffs are causing weakness, surely at some point that would start to turn up, to occur. And that's why the data we're starting to get over the next few weeks is going to be important to either sort of debunk this idea that, the US economy is going to be sort of collapsed because of tariffs, or at least weakened because of tariffs. On the other hand, maybe we will get that evidence. So the market's got to be very sensitive. But what we can see here as well, if you look at this sort of graph here, this is the core sort of private sector employment growth. So that's excluding government, excluding sort of teaching, education, jobs, and healthcare. And you can see here that it's actually relatively robust. It's not actually falling. So at least from this sort of core sort of private sector sort of graph here, you can see that, again, that's just another metric here showing that US core employment is doing sort of okay. It's not ripping, but it's certainly not collapsing. And also, if you look at the number of sort of hours worked per week, you can see that that's actually sort of pretty steady, even went up last time. So the point is, from some of these graphics here, is that you could say that the employment situation is actually sort of solid, although probably weakening just a little bit. So that brings us back to the JOLTS number now, and let's just see what's expected today. That's coming out at 10 o'clock, so in a couple of 2.5 hours or so. So we see here the jobs openings expected to be about the same as last month at 7.1 million. Let's keep an eye out for that. What's also going to be interesting is the quits level. Let's just see if people are quitting less. Of course, the less people are quitting, that's probably a negative sign that people are nervous about holding on to their jobs. And then, of course, we want to see the layoffs level. So, are companies actually sort of, terminating people or not? And as you can see, that's expected to go up to 1.6 million from about 1.5 million last time. So that's an extra 100,000 400,000 here. So definitely quite interesting to keep a lookout on that. Other thing as well, which we also have at 10 o'clock, just a little bit more data, is the factory orders. I like to look at the factory orders excluding transportation. And again, that is expected to be a bit stronger. So we're getting a sort of a mixed data points at the moment. Obviously, we also have ADP tomorrow, then we have ISM services, and of course, the big one on Friday, we have the non-farm payroll. So I think by the end of this week, there will be the narrative at least will have maybe gone one way or another. And that is probably going to be, probably determine where the equities go. Sort of positive news probably going to push the equities up. Negative news or a sign of a slowdown, of course, is going to do the opposite. The other interesting thing overnight, we did get some data out of China. We had the Caixin manufacturing, and that came in that's the private survey. That came in at 48.3 versus 50.7 expected. So the idea here is in China, a bit of a slowdown there in the manufacturing PMIs. That's reflected. That was, for example, currencies like the Australian dollar, which we can bring up if I can find it here. The Aussie dollar just being a little bit sort of weak on that, because obviously that's a sort of a proxy and quite important for the Aussie dollar. So you can see the Aussie dollar here just sort of grinding its way up in sort of a sideways consolidation here, but it is still holding above all of these moving averages here. So it's above the 200-day, which seems to be some kind of sort of lower level support here. So again, that's probably going to be not only dependent on Chinese data, but also obviously what happens with the US sort of dollar. Now, talking about actually, just while we're talking about China and the effects of that, interesting to look at copper here. Copper sold off a little bit, and copper actually, and again, when I say copper, I've got the high grade, which trades on the New York Exchange. And as you can see here, it had a bit of a rip here yesterday above its 61.8 fib retracement. So that's the big fib retracement going all the way back to the end of March here. So you see that level there, pretty key level, but it couldn't actually close above that. And you can see overnight it was a little bit soft, possibly on the Caixin manufacturing PMI, which was lower than expected, because if China manufacturing is weakening, that's not great for the copper market. But the other issue here is that why did copper in the US pop yesterday? And that was probably on the back of the fact that Trump increased the tariffs from 25 to 50% on aluminium and steel. And the idea here is that there's still sort of an investigation going on into the copper industry. And the idea, at least from traders' point of view, is that at some point there will probably be sort of tariffs imposed on imports of copper into the US. Therefore, we've been seeing huge stockpiling of a physical copper at the New York exchanges where this stuff is traded. So it's interesting just to look at, this is the, as I say, the HG, the high grade US contract here. Just look at that price action, because I would just want to show you quickly the London price action. And you can see here, it's still quite strong. So this is grade A copper as traded on the London Metals Exchange, where of course, in England or the UK, there's no threat of tariffs on incoming copper. So you can see quite a different chart there, a little less volatile and than what's going on in the US. So that's kind of interesting. Just while we're on the metals here, silver yesterday had a huge pop. Again, I think this could be just hitting stops above the Fibonacci levels now, moving averages moving up. Let's see if it tests these recent highs of about $35 or so, just coming off a little bit today. That's on a softer dollar. Was yesterday's sort of rip high, but also on the back of gold. And of course, we look at gold. This is the spot price here. We talked about it yesterday. Again, all the moving averages. Still, the bulls are in control. Moving averages, momentum up. It's cleared the 61.8 fib retracement from the most recent impulse. We've had a pretty weak US dollar, which is helping. A lot of geopolitical tension, which is helping. Also, sort of a sell US assets kind of vibe. Which has been in the air, obviously, for a few months. So at this point here, it all looks pretty solid. You can't say anything really negative about this chart. I suppose the next upward sort of target is going to be about 34.30 by the looks of things. At this point, difficult to buy it up at these levels, but it is still bullish. Having said that, we are starting to get, compared to the very aggressive sort of price action, we are starting to get a little bit of sideways consolidation here. So another way to look at this is that this is just sort of consolidating, maybe for another bull run. If the tariffs kick in and inflation remains sticky, who knows? Maybe it's going to push up to $4,000 at some point. Other stuff which was interesting overnight, which I was looking at, quite a few comments coming out from Ueda in Japan, the Bank of Japan governor. And that's just specifically in the bond market. So let's just bring up a USD, a JPY chart here, just while we're having a chat about this. So you can see here that the US dollar has been weakening. Well, obviously in the last 6 months, but let's say over the last sort of 2, 3 weeks here, it's been weakening, but it actually popped a little bit here against the Japanese yen. Why was that? That's because Ueda in front of Parliament yesterday was essentially saying, just keep in mind that the Japanese, the Bank of Japan. Let's sort of throw up a quick graphic here. The Bank of Japan. Is one of the major buyers here. In fact, is the major buyer of Japan's bonds. So have a look at this. So share in total Japanese government bonds outstanding. The Bank of Japan owns over half. So over half of the bonds are owned by the Bank of Japan. Then, of course, you have life insurance banks, pension funds, only foreigners, so sort of non-Japanese market participants, it's only about 6%, so quite small. So really, it's all about the Bank of Japan and some of these big life insurers. But basically, why have they been doing that? The Bank of Japan has been sort of doing huge amounts of QE for almost like 20 years, just because Japan was in a deflationary spiral. It was trying to get inflation up to stimulate the economy. So just enormous amounts of sort of spending by the Japanese government, and those bonds were bought primarily, as we can see, by the Bank of Japan. But there's been a little bit of inflation over the last 6 to 12 months. We're seeing wage growth rise a little bit, and essentially Ueda, the governor, they have decided that they're actually doing a little bit of quantitative tightening. So they're actually, not reinvesting to the tune of about 400 billion yen every quarter. So every quarter they're buying or not reinvesting about 400 billion sort of yen. So the point is there's a little bit of quantitative tightening at the moment. And of course, what we have seen over the last few weeks has been a lot of instability and a lot of volatility at the long end of the curve in the so-called super long bonds, the 40-year and the 20-year. And we've seen those yields spike up quite a lot. And that's important because that's putting a sort of upward pressure on the yen, but also it's creating some instability. And keep in mind that this Japanese bond market is the second largest in the world. So that's also putting at the periphery upward pressure on, let's say, German bund yields and also US 30-year yields. So if the Japanese bond yields at the long end are going up, that's putting in other developed markets bonds putting up their yields as well, which of course is a problem for everyone else. So the thing is, yesterday Ueda made some interesting comments, and essentially, which I followed, and essentially he was saying that market participants, they did a survey of a lot of the primary dealers, and essentially the primary dealers are saying that it was okay to continue not reinvesting as much. So continue the QT, but maybe not at such high levels. So that's why the Japanese yen sold off, because there was a sense that this was a bit dovish, that maybe the Bank of Japan was considering reducing the scale of their quantitative tightening just a little bit. Over the next sort of few quarters, and that was put some downward pressure on the Japanese yen. Secondly, what Ueda said is that they wouldn't hike rates just for the sake of having a high sort of interest rate, which they could then sort of reduce in the case of a recession. He said they would have to see actual wage growth and actual inflation, and so that was a little bit dovish as well. So that put a bit of downward pressure on the yen. Subsequent to that, though, we actually then later in the evening, overnight, we did get a pretty strong auction for the Japanese 10-year, and so that calmed the nerves about the sort of the long end, and we've subsequently seen the Japanese yen come back just a little bit. So let's keep an eye on what's going on over in Japan. Quite interesting stuff, especially in terms of what's going on with the bonds. So if we just get back here to the currencies, the US dollars had a little bit of sort of a strengthening overnight. So we can see here that US dollar up just a little bit against the Japanese yen. But to be honest, this is still a very negative looking chart. Look at all the moving averages, all very solidly showing downward momentum. We can see here that this most recent impulse, the US dollar sort of push high, was rejected pretty carefully, seriously here at the 61.8 fib retracement, which is almost at that point was about the 50-day moving average as well. And you've got to say that the most probable path going forward is for the US dollar to continue weakening a little bit, probably down at least to this 140 level. Which, as you guys can see here, is a very key level. It's kind of like a triple bottom. So that's going to be a pretty juicy and attractive target. On the other hand, the euro has been sort of strengthening again, just coming off a little bit overnight and this morning. But the euro basically trying to push up to those recent highs of about 115 or so. What we did get recently in the last hour or so, we got flash sort of CPI readings for the eurozone. They were actually a little bit lower than expected. Expected about 2%. They came in at about 1.9%, if my memory doesn't fail me. So that's interesting in the context that we have the ECB on Thursday. In a couple of days, they're expected to cut one more time. But as I was saying yesterday, it could be that they may want to signal to the market a little bit of a pause just to see what's going on, because they have cut relatively regularly over the last sort of few meetings. But nonetheless, it does seem as though inflation in Europe is definitely trending downwards. So that gives the ECB a little bit of cover to continue cutting if should the economy weaken. And again, that's putting a bit of downward pressure just today, at least, on the euro versus USD. Apart from that, oil. Let's have a look at oil. Oil. Pushing a little bit higher. It's got a pretty key resistance here at the 50-day moving average. You can see here that in the past that's been a little bit of resistance. It's interesting that we know that OPEC Plus over the weekend they raised their output, their production output, another about 400,000 barrels. That's the number which they've been doing over the last few meetings. That was a little that was kind of expected by the market, and in fact was maybe a little less in terms of production hike than the market feared. So we had a nice pop yesterday, which has given back a little bit, but it looks as though it's going again. We've got a slightly, the US dollar is not too strong. And, as long as we continue to have relatively strong global demand, and that still seems to be the case, oil could pop high here. Also, because positioning, the market is very stretched short in terms of commodity CTAs and momentum traders. Everyone's very, very short here. So if this pops out of this sort of sideways consolidation box here, we could and pops above, first of all, let's say this 50-day moving average, then about the $64, and then let's say the 64.60 level. So a couple of levels here. There's going to be a lot of stops here. And oil, I think, can definitely pop higher just on a short squeeze, maybe not even fundamentals. On a short squeeze can probably pop higher another $2 or $3, at least, let's say, up to the 100-day moving average, which would be roughly congruent with or coincident with the sort of overhead resistance here at about $66 or so on the WTI. So that's about it, guys. As I say, we have the Jolt starter today at 10 o'clock in a couple of hours, which will give us another direction. Other thing I'm looking out for is just to see what's happening with the bonds. Let's just have a look here at the bonds. So you can see here something like just the 10-year, just sort of sideways consolidation at this point. Really looking for data for the next move. As you can see here, just clustered around the 100, 200-day. Actually, all the moving averages just pretty much at a sort of point of control here around about the 110.19 on the ZN contract. The next direction, up or down, will no doubt be determined by the series of data points we get over the next 2 or 3 days. Okay, thank you. Hope that was useful. Let's keep the conversation going. Thank you. Have a great day.